Good afternoon. This is Rupert Thompson, Chief Investment Officer at Kingswood Group, and it's the 29th of June. And what I'm going to do in the next few minutes is really just run through key developments for the markets last week and also our views for the coming weeks, coming months. Well, last week was actually a down week for markets. Global equities were down 2% or so, and this very much continues the choppy pattern you've seen over the last month or so up one week, down the next. And I think this pattern is probably going to continue over the coming months. As to why markets were specifically down last week, well, for once, you can't blame it on the economic data. We had the purchasing manager indices, the business confidence numbers out for the US, UK, and the Eurozone, and effectively business confidence bounced more than expected in June. And business confidence is actually now up substantially from the lows of 2 months ago. This is reassuring, but only to an extent. And the reason for saying that is it's not that businesses are actually saying things are improving. All they're doing is saying that things aren't half as bad as they were 2 months ago, which in a sense is no big surprise. But for what it's worth, business confidence is bouncing back faster than expected. So why did the markets fall last week despite this apparent good news? Well, one reason I think is that the shortly afterwards, as it were, poured cold water on any hopes of a rapid recovery in the economy. Essentially, they released their latest economic forecasts, and they are considerably more gloomy than they were a couple of months ago. So in terms of the global economy, they're now expecting a decline this year, a contraction in world GDP of close to 5%, whereas back in April, they were looking for a decline of only 3%. And to put this in perspective, back in the global financial crisis of 2009, the world economy actually only shrunk by a minuscule 0.1%. This year, by contrast, we're looking at a decline of close to 5%, so much worse. But clearly, markets are very much forward-looking, and in terms of the shape of the recovery which the IMF is penciling in, this is really sort of what the market's interested in. The problem here is that apart from the sort of first few months of the recovery over the coming next few months or so, there's no way you can really describe it as a V. It's very much more a U-shaped, a rather flat recovery. So the IMF is very much saying is you're not going to see a rapid return to normality anytime soon. And strikingly, for the advanced economies, even by the end of next year, it still sees GDP in the advanced economies being lower than where it was at the start of 2019. So that's one reason why the markets came off a bit last week. The other reason is that there has been a pickup in COVID infections in a number of cities, a number of countries in the last few weeks. We had outbreaks in Beijing, outbreaks in Berlin, and rather closer to home in Leicester, in the UK. But what has, I think, spooked markets even more last week, with the main focus last week, was the pickup in infections you've seen in a number of US states where lockdowns have been eased fastest. So in a number of the number of the southern states in the US, Texas, Florida, and Arizona, you have seen a marked pickup in infections. And as a result of this, you've seen in some of these states renewed social distancing measures put in place. And there is now this stark contrast, at least at the moment, between what's going on in Europe, what's going on in the States. In the Europe, overall, infections remain under pretty good control, whereas in the States, you've seen a significant pickup in the last few weeks. And it's not that anyone is really expecting these pickup in infections to lead to a wholesale reintroduction of radical lockdowns. It's just that it does mean that social distancing, worries about catching COVID are going to remain prevalent for the foreseeable future, unless of course a vaccine is found in short order. So just more reason, as it were, to doubt that we're going to see a V-shaped recovery in the economy. And the problem here is that if you look at equity market valuations, they are on the high side. the global equity price earnings ratio, even if you build in earnings for next year rather than this year, i.e. take into account they should rebound over the coming year, valuations are back up to the highs of the last 2 years. So the global PE ratio is back up to around 17 times. And this very much seems to be saying the equity markets, even with their decline of around 5% actually now from the highs they touched back on the 8th of June, even with those declines, equity markets are still rather looking on the bright side of things. And that, in a nutshell, is why we are somewhat cautious over the coming months. We do think this economic recovery, sure, it's going to continue, but it is not going to be as sharp or a straight line as the markets are still pricing in. So we think there is room for markets to correct somewhat over the coming months. Anyway, those are our views at the moment, and I will be back again next week to update you on any further developments. Thank you.